Markets are anticipating major volatility, but will it actually unfold? You came here for the truth. This is going to be an interesting video because I'm going to show you so many different charts and indicators. It's going to make your head spin. The first thing we're going to talk about is the repo operations. I've been covering this for a while. I'm going to give you a little bit more detail, expand on it. For anybody who's confused about it, definitely watch that section. The second thing we're going to look at is the major markets, inflows and outflows. If you want to know where the money is going to right now, make sure you take a look. And number three, shortages of all kinds, commodities, semiconductors, the prices of goods. This is going crazy. I'm going to break that all down in that last section, so you definitely want to stay tuned. Let's go. All right, the repo operations. I've been talking about this the entire time from September 2019 all the way through, bringing it up now basically on a daily basis. And now we finally have the Wall Street Journal getting in depth with it. Better late than never, they say. Cash is flooding into the short-term markets like never before. Is that a bad sign? Wall Street is watching for signs of broader financial stress as trillions of dollars change hands every night. I have been talking about it. I think it's important. A lot of people have questions. What is it? I don't understand it. Well, there's a simple explanation right here that I wanted to show you, and then we'll expand on that. A repo transaction is simple. The borrower sells the lender a security, such as a treasury bill, for cash. At the end of the loan, which, by the way, these are like one night things, so it's a very short-term thing, the borrower repurchases the security from the lender for a little bit more. That extra bit is the interest earned by the lender at the Fed's reverse repo facility. The central bank is the one giving the security and taking the cash up front. So you're seeing today right now, as they highlight a little bit further up, if I could bring it to you, the Federal Reserve was giving 0% for a period of time, and still the banks were moving their reserves, they're putting them at the actual central bank instead of loaning them out to people and businesses and so on. Now the incentive is slightly higher, 0.05%. That's what it is. But as they mentioned right here, and something I've been talking to, if you're a subscriber, you know that I've been mentioning this, a higher interest rate should attract more money. But analysts said that they were surprised by the speed at which the firms moved into reverse repo from other short-term investments such as treasury bills and commercial paper. See that? It's a risk-free thing. We could bring it in, we could cycle it back, and we could make cash and roll it. That's what they're doing right now. Now this right here just gets to a little bit more detail. Let's cover it really quickly. Traders say that the repo is the number one market that they gauge short-term bond markets. For the Fed, repo is meant to prevent overnight interest from going too high, and the reverse repo is meant to prevent them from going too low. Quote, it helps with policy implementation. So I asked the question, why doesn't the market just set the interest rate? Why are we letting the central bank set the interest rate when clearly it wants to move in a different direction? If the market would decide the rate, it would be a lot more sensical. But let's move away from that. All right, let's take a look here. You saw the jobs numbers. You saw the information that had come out. Look at this from Real Investment Advice. And by the way, if you haven't seen the interview I did yesterday, by the time I'm recording this video and posting this video, yesterday, Real Investment Advice, I interviewed Lance Roberts, and this is Real Investment Advice's website, and they have this report here today that I wanted to show you. Without seasonal adjustments, so you saw that fantastic number that came out, right? Well, look at this. Without the seasonal adjustments, employment fell by 133,000 people. As you would expect for July, the vast majority of hires were retail, hospitality, and teachers, vacations, retail, and back to school. Notably, after a significant layoff cycle in March 2020, jobs are returning to normal. It's not a cycle of new job creation due to a booming economy, rather just the re-employment of those let go. And by the way, what they suggest here is there's still a while to go, but they just wanted to make it clear those aren't new jobs created. That's not a booming economy. That's just trying to catch up. Very clear, very, very different. Now, if you look at this, it comes from Bank of America. They're just showing you what's happening as a signal, because there are so many different signals, so many different indicators, whether you're looking at the Dow theory with the Dow transports essentially having fallen and the S&P rising, and that tends to be an issue. It's kind of a leading indicator. But you also have this, emerging market equities approaching 20-year low versus S&P 500. Cathartic events often coincide with secular lows in emerging market versus US. But emerging market is where the value is. Taking a look at this, there have been some events in the past, and when it bottoms out like this, LTCM in the 90s, and then of course Lehman Brothers didn't get down to this level, but you can see kind of the same situation, right? Diversified portfolio is annualizing a 16% return, the best since 1987. Have you heard of this recently? Many people don't talk about a diversified portfolio. What's a diversified? They're talking about 25, 25, 25, 25, equities, bonds, commodities, cash. Okay, that's like a financial advisor type of diversification. But what does that tell you about what's happening today? I mean, it's truly unique to see the everything bubble and the potential effects of that. Inflows into growth have resumed after Q2 redemptions. So you could see that right here, the red. I'll just highlight it again for you. After the second quarter redemptions, money was moving in, and I was noting this, talked about this a lot. There was the rebalancing act that was happening with portfolios. Things have changed. More money is moving back into, as they say, tech and healthcare over the last the 4-week moving average anyway, and it just gives you a little bit of an idea as to where institutional investors are parking their money. And as always, the data comes from the EPFR. I always highlight them because they're able to track all of that. Cyclicals that saw big first half inflows have seen recent outflows. Then on the right hand side says the past 6 weeks have also seen redemptions from value. So value stocks not seeing the love, okay? This is important. That doesn't mean that you should be chasing the herd. Well, you do what you want with your portfolio, but I'm just showing you exactly what's been happening. You got to see what's going on with gold. You see that? A little bit of a flash crash. Yes, that's right. This is just giving you a little bit of an idea as to how these markets are just extremely volatile today. I can even show you this chart here, which I showed on a live session last night if you were there. Hello. I wanted to give you a little bit of a further breakdown. You could see what's going on. The price action, I mean, this thing came down to, at least on my chart, about 1680. 1680 for gold, pushed way back up. I mean, that wick is a very long wick. So you could see the buyers came back in to buy it up. Currently, as I record this video, it's at about 1737. It is sitting below the Bollinger Bands. I'm looking at this on the daily chart. And, you're just seeing it over the period. After it came down back in, let's say the June timeframe, mid-June timeframe, it's been kind of like within this range, 1800, 1830, and just not much activity has been occurring. But right now, this could be another moment where it just gets slammed down yet again. And we've seen this time and time again, how much of these type of things going on behind the scenes. It's hard to really depict what could come in the near future. But as I always say, when all else fails, then they turn to gold. Number one, emerging markets right now today are sending a signal. How many people are picking up on it? Number 2, money is moving into growth stocks and out of value. This is a big change over the last couple months. Number 3, everything we are seeing today is a build up to a major market event. Where is it going to come from? Nobody really knows, but many have been pointing to another lockdown crushing the economy, but only time will tell. Take a look at this chart right here. I'm just going to show you a few more things and we're going to finish off this video. The semiconductor and auto industries pose the greatest spillover risks from Asia to the US. And I'll just highlight it quickly, although I'm sure you could see that. Just taking a look at that breakdown compared with chemicals and plastics and food and furniture, apparel and autos, it is clear the import exposure of supply constrained commodities. This is a big one. And now look, semiconductors are everywhere, whether we like it or not. All right. They're in the cars, they're in the phones, they're in the dishwashers, they're in the fridges. I mean, it's crazy. Why do we need all these computer chips everywhere? But they're all there. And so the more we have of these in there, the worse the situation is going to be. There's talk about expanding the semiconductor manufacturing in the United States. That is not something, okay, first of all, that's probably a very good thing, but you just don't, set up a factory and it's ready to go. It takes a long time to make that happen. Long time. And of course, in line with that, we have this. The Argentine River that carries soybeans to the world is drying up. Key waterways troubles deepen strains on national recovery. Falling export values, rising energy imports chip away at the peso. Now you're seeing this here, and it's just one of many. You've got the fires, you've got the droughts, you've got all these different problems that are going on right now, putting further pressure on the supply chains, on the resources, the food supply and everything. And of course, what does that mean for you? What does it mean for you? That means prices are going up. That means things are going to become more expensive. That means you have less spending power. Your dollar isn't going to buy what it did before. Now, it's unfortunate, but that's just the way it is. Now, look, this infrastructure bill that they're trying to pass, I did my live video about that, talked about it more in depth towards the beginning of that video. If you want to check it out, check my Twitter and Facebook where it's still live. But this right here is basically just getting into how crazy it is. 2,700 pages, and they stuck in crypto regulations in there. Why? Why? Because they know that they want to get this thing passed. They're going to rush it through and it's going to affect different industries. Crypto is just one thing. I'm sure there's a million different things that are in there. Even Jack Dorsey got in on it and a bunch of other people too. Just looking at this, Red Alert and all these things. They're trying to do an amendment to it. The amendment's not good enough. Who knows? But essentially, just really quickly, break it down what it is. They agreed on a proposal that will give the federal regulators authority to impose new tax reporting obligations on cryptocurrency brokers, which enable traders to buy and sell cryptocurrency. But the language of it is so broad that they can make basically anybody and everybody put this on anybody and everybody, and unfortunately, it's probably not a good thing. They believe that this is going to bring $28 billion over the next 10 years, but who really knows? It's usually more likely about control. Look, if you were worried about control, you don't like these systems, well then the way around this is setting up our own system, and that's what I did with the insiders. That's what I did. I made this on purpose because I'm tired of hearing from people saying, "Oh, I didn't get your notification. Didn't get your notification. I got the bell on. I don't know what's going on." Every single day people do this, okay? I'm tired of it. I set up the insiders. If you want to join me on this ride to 300,000 subscribers and beyond, if you want to be able to get around all the censorship and the shadow banning and so on, you got to join the insiders. I'll put the card up here, or just go for free, of course, to themoneygps.com. And don't forget to hit that like button. If you're still here, come on, you got to hit that like button. Really important to help out the algorithms, to let this know that this is a good show. You want to see more of it and so on. If you haven't seen this video yet, you definitely want to check it out. Click it and I'll see you there.